Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is Brent Foster. Today is April 22nd, and I'm going to release the weekly market insights today and recap last week and talk about the markets, the economy, and where things are at, where they might be headed. So, U.S. stocks slipped over the shortened trading week last week as Q1 corporate reports started to roll in. The S&P 500 dropped to 1.5%, closing at 2,282.70, while the NASDAQ composite fell 2.62%, closing at 16,286.45. The Dow Jones Industrial Average lost 2.66%. The MSCI EFA Index, which tracks developed overseas stock markets, added 4.19%. So international markets were up. So U.S. stocks slide. Stocks started the 4-day week with modest gains. Trade volatility subsided as several money center banks reported Q1 numbers at or above expectations. Stocks trended lower midweek after Jerome Powell expressed concerns that tariffs would likely move us farther away from our goals, including keeping inflation in check. Stocks were mixed on the week's last trading day as traders evaluated White House news that trade deals were progressing with Japan, China, and the European Union. The S&P 500 ended the day higher, but the Dow Industrials were under pressure after a large healthcare company gave disappointing Q1 report. So, thank you to Y Charts for this. Got a post out there on the blog. The NASDAQ, which is the tech space, tech-heavy NASDAQ, year-to-date trailing's down 15.5%. S&P 500's down 9.83% for the year. Dow Jones Industrial Average is down 7.56% for the year. And the MSCI EFA Index, which is international developed markets, up 6.79%. All right, the 10-year Treasury note closed at 4.34%, and we'll be tracking that one. Fed's influence. U.S. President Donald Trump called for the termination of Federal Reserve Chair Jerome Powell, adding to investors' concerns this week. The president said in a social media post on Thursday that Powell should certainly lower interest rates. Powell's termination cannot come fast enough, Trump said. This came after Powell on Wednesday said tariffs are highly likely to generate at least a temporary increase in inflation, though price measures may be more persistent. Quote, "We may find ourselves in the challenging scenario in which our dual mandate goals are in tension," end quote, Powell said. So housing March housing starts declined by 11% compared to a month earlier to a 1.32 million annual rate, according to the U.S. Census Bureau, compared with the 1.42 million estimate compiled by the Bloomberg survey. Tech sector. So technology had the largest percentage drop, sliding 3.7%, followed by a 3.2% decline in consumer discretionary and a 2.9% loss in communication services. Healthcare also fell, slipping 1.2%. Among technology stocks, NVIDIA fell 8.6%. The company said it expects a $5.5 billion charge in fiscal Q1 linked to its H20 product line after the U.S. government said it must secure an export license for China, Hong Kong, Macau, and D5 countries. Advanced Micro Devices shares also fell, shedding 6.4%, as the company also faces new restrictions on exporting advanced microchips used for artificial intelligence applications to China. Amazon was hit hardest in consumer discretionary sector, falling 6.6%. Chief Executive Andy Jassy said Thursday its network of third-party sellers may pass the cost of Trump's tariffs on to consumers, CNBC reported. The real estate sector. The real estate and energy sectors of the S&P 500 were the top gainers this week, up 3.9% and 3.2% respectively. In real estate, Prologis was up 6.1%. The company reiterated its 2025 guidance after first quarter results surpassed Wall Street's estimates, while pointing out that policy uncertainty is making customers more cautious. APA was one of the top performers in the energy sector, gaining 7.2%. The company named Ben Rogers as chief financial officer starting May 12th. Rogers, who succeeds Stephen Riney, has worked at APA since 2018, most recently as its senior vice president for finance and the treasurer. Riney will continue his role as president, overseeing asset development operations, the company said. So this week, key economic data. Monday, leading economic indicators. Tuesday, Philadelphia Fed President Harker speaks. Wednesday, Chicago Fed President Austin Goolsbee, St. Louis Fed President Alberto Zalem, Atlanta Fed President Bostic, and Fed Governor Christopher Waller speak. PMI services, PMI manufacturing, new home sales in the Fed Beige Book. Thursday, durable goods, weekless jobless claims. Friday, the consumer sentiment final one. All right, this week, notable companies reporting earnings. Tuesday, Tesla, GE Aerospace, Verizon, Intuitive Surgical, RTX Corporation, Danaher, Lockheed Martin, and Elevance. Wednesday, Philip Morris, IBM, AT&T, ServiceNow, Thermo Fisher Scientific, Boston Scientific, NextEra Energy, Texas Instruments, and the Boeing Company, and CME Group. Thursday, Alphabet, which is the parent of Google, Procter & Gamble, T-Mobile, Merck, Pepsi, Union Pacific, Gilead Sciences, Comcast Corporations, Fiserv, Bristol Myers, and Friday, rounding out the week, AbbVie. So it's a busy week for earnings. So small business healthcare tax credit. That's the tax tip of the week. The IRS introduced the small business healthcare tax credit in an effort to extend healthcare benefits. This credit may benefit employers with fewer than 25 full-time equivalent employees, offer a qualified health plan through a small business health options marketplace, and pay at least 50% of the employee-only healthcare coverage cost. There may also be some average wage requirements. The maximum credit covers 50% of premiums paid for small business employers and 35% of premiums paid for small tax-exempt employers. The credit may also be available for 2 consecutive taxable years. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. All right. So here's a fun one. This is non-financial related, but it's still fun. Brain training. Ways to exercise your brain. It's a great way to keep your mind in shape. These fun games are designed for people of all ages. Improve your mental health fitness with games like Sudoku. The strategy game requires you to find correct order of numbers 1 through 9 in a 3x3 grid. There can only be one of each number in each row and column. Crossword puzzles find the correct word for each clue. The words intersect and share letters, so you have to make sure that you have the right word. Otherwise, the puzzle won't fit. Peak. Something called Peak, a brain training app for your phone or tablet, offers several different games designed to improve cognitive function and problem solving. And this tip was adapted from Very Well Mind. All right, moving on to the next segment. Got a lot of information for you. Levels, S&P 500 levels. I have the stock chart pulled up along with Y charts. And basically what I have is the S&P 500 index. And just looking at the RSI, the MACD, the full stochastics, the ADX, the 200-day moving average, the 50-day moving average, got volume in there and price overlay, of course. On this particular chart I'm looking at and discussing, I have a 3-year range. It's a weekly chart, okay? And what I'm looking at is S&P 500 all-time highs, February 19th at 6144 and change, somewhere right in there, okay? And since then, we've gotten a pullback or a correction, and technically pricing in potentially a bear market, but that remains to be seen. Not enough time has passed to confirm that. But we are still in a bull market uptrend over even the past 3 years. If you look at the last decline and bear market being 2022. Okay, we came out of that, had a wonderful 2023. But basically, in 2022, we hit a bottom in October, and that the S&P 500 was trading quite low then. You're looking at below like 3,600 range. So this range between 35, 36, 3,700 was a bottoming process. At the end of 2022, we had an enormous rally and a push all the way up to 6,100 and change, like I just mentioned. Now we're getting a retracement, a 50% retracement of that move. We already have gotten that. And now we are trying to find the bottom. And the bottoming process is going on. And it looks like the weekly candle chart put in just above 4,800 as that bottoming process. Now we're trading around 52.47. Yesterday we had a volatile day and a sell-off of 3%, which tested a 5,100 candlestick level. So we've basically are processing that bottom. It's going to take some time to flesh out over the next probably 4 to 8 weeks. And we'll see where things end up. And it's interesting that the market is up quite a bit today after a pretty ugly day yesterday. So we're going to have quite a bit of volatility. It's back, but a disciplined strategy and staying the course is a smart way to go. All right. And looks like the 200-day, 200, the 200 weekly moving average is 46.90 on the S&P 500. We're definitely holding that. We are trading below the 50, which is 56.85. And so we're trading right in between those levels. If you zoom in on a daily chart, it doesn't look that great. It looks worse. But if you zoom out, which is always a good thing to do when you're looking at charts and analyzing, we're still in a nice bull market uptrend. We are substantially correcting, but we are finding the bottom in that process. Hopefully, we get some good news. And this, by the way, is out of oversold conditions. A VIX spike of 60, oversold, the height of pessimism, the height of bearishness. Everybody's negative. Everybody's fearful. That's usually a good time to be looking to add. And also it's a good time to review your strategy and have some reprieve, feel a little better about where things are headed, because a lot of negativity is priced in, and hopefully that was the end of that. But and then we can kind of establish a base over the next several months and not look back, and we'll see how that goes. But that's where the trading is right now. That's where the chart is right now. I feel like that was worth talking about. And I'm excited about the future. And I'm excited to have opportunities like this and not always be investing towards the top. And so, anyway, bear markets don't last forever. It's just a period of time, and we'll get through them all together. All right. Stay tuned for the next segment. So I want to talk about the long-term power of markets, growth of $100,000 investment over 35 years. So first quarter of 1990 through the first quarter of 2025, S&P 500 annualized 10.39%. That's a total return, but think about that. Annualized 10.39%. U.S. small caps have annualized 8.82% over that time frame. And long-term bonds annualized 5.64%. Gold is annualized 5.88%. Short-term bonds 3.98%. And the inflation rate over that period of time is 2.68%. So keep that in mind. Over a long period of time, you are rewarded by being in the U.S. markets. And also that inflation is since 1990 to today, about 2.68%. I'm glad that the inflation beast is around. Currently, we're right around 2.9%. So just above long-term averages. And the power of staying invested, you guys. As volatility is out there, as there's fear going on, there's a lot of headline risk, a lot of headlines, just crazy every single day headlines ever since January 20th. But the power of staying invested, the value of staying invested, even through volatility, the growth of a $100,000 investment over 20 years from the second quarter of 2005 through the first quarter of 2025. So a buy and hold strategy, the S&P 500 is annualized 10.23%. So an annualized return, 10.23%. If you move to cash at the bottom of 2008, the financial crisis, and you did that for 1 year, your annualized return would be 7.28%. That's 2.95 fewer percentage points per year than if you would have just bought and held. If you move to cash at the bottom of the great financial crisis and hold, okay, meaning not re-enter the market a year later, you'd be at negative 1.47% annualized return. So you're actually 11.70% fewer percentage points per year worse off than if you had just bought and held during the GFC, basically since 2000, second quarter of 2005 through the GFC all the way to today. So obviously you can see there's great power in staying the course and staying invested. Now, the power of staying invested continues. So let's say we have a growth of $100,000 over 10 years from the second quarter of 2015. So we kind of moved up a decade. So second quarter 2015 through the first quarter of 2025, buy and hold the S&P 500, you'd have an annualized return of 12.50%. That's awesome. That's actually above its long-term average. If you moved to cash at the bottom of 2020 during the pandemic crash for 1 month, you'd have an 11% annualized return. That's 1.5% fewer percentage points per year than if you just bought and held. Move to cash at the bottom of 2020 crash. So let's say the pandemic crash, you moved out of cash, you never really got back in, and you just stayed in cash, you'd have a 4.05% annualized total return. That's 8.45 fewer percentage points per year than if you had just bought and held. Now, I do want to make a point here. Inflation during the course of 2022, you guys, was like 9%. So even though you get a 4.05% annualized total return on your cash, if you'd moved out of the market, your purchasing power would have been eroded by a very high inflation rate that happened in 2022 to early part of 2023. And the Fed had to raise rates during that time. That's why you got a higher cash percentage, but you're still losing money to inflation at 8-9%. Okay. Time in the market versus time in the market. So missing out on just the 10 best market days in the last 25 years significantly diminishes your total returns. So the importance of staying invested, the effect of missing out on the best days in the market from March 31st of 2000 to March 31st of 2025. So over the last 25 years, if you missed the best 10 days, your annualized return would have gone from 7.41% down to 4.11%. Missing the best 20 days, you drop again to 2.13% from 4.11%. Missing the best 30 days of the market, 0.48% would be your return, down from 2.13% on an annualized basis. And then missing the best 40 days, you'd be actually negative 0.99%. From being positive 0.48%, and then missing the best 50 days of the market, you'd be down 2.35% if you miss the best 50 days in the market over the last 25 years. So you really don't want to miss those good days. You've got a huge underperformance over just 50 days, over 25 years, having a difference of a negative return, 2.35% negative to 7.41% positive. So that dispersion is fact, and it's really profound, and you really don't want to miss those days. All right. Dollar cost averaging versus lump sum investing, especially in a volatile or down market period like 2022, dollar cost averaging can yield a lower cost per share and greater returns or lower losses over a given period. So, this is the first chart that I'm going to talk about and piece that I'm going to talk about. You got a lump sum investment of $12,000 up front, and you purchase, let's say the S&P 500, and you're able to buy 25.19 shares at an average price per share of $476.30. In 2022, you'd have been down 18.17%. Versus dollar cost averaging in a down market is important, is something to think about doing. Total amount invested, $12,000, $1,000 a month. Think about that as you're buying into the market. The number of shares you purchase is 29.08. So it's a little bit, you've bought more shares over that period of time. Average price per share is 412. So you're buying more shares at a cheaper price overall as you average in as the market is turning down. And your downside in 2022 would be 6.19% versus down 18.17. So averaging in during a down period or a bottoming process in the market during a recessionary period, because that was the last bear market that we had was in 2022. And everybody remembers that. Bonds were down like 16. The market was down like 18 to 20, depending on when you were invested and stuff like that. So it was like the worst year in the bond market was in 2022. And then we had 23 and 24, which were absolutely fantastic years in the equity markets. Over the last 20 years, say you invested from April 1st, 2005 to March 31st, 2025. Dollar cost averaging, $240,000 over that period, $1,000 a month. Of the S&P 500, the number of shares purchased would have been 1,281.68 shares. The average price per share, $187.25. Annualized return, 6.96%. Versus if you would have just 20 years ago, April 1st, 2005, bought $240,000, just bought the market. The number of shares you would have purchased would have been 2,023.10 shares of the S&P 500. So you would have bought more shares than you would have dollar cost averaging. The average price per share would have been less than dollar cost averaging at 118.63. So that's significantly below the 187.25 average in during that time. And then the annualized total return would have been 10.15% per year versus the 6.96%. So when you average in, it's better to average in if you're looking to deploy capital during a down market. But during an up market or a bull market uptrend, it's better to just buy the market and leave it over a long period of time. That's what the facts are saying here as you examine market analytics and charts. All right. The rolling returns since 1950. So average 20-year return of the S&P 500. These are rolling returns, 6.99% per year. Average 10-year return of the S&P 500 is 7.39%. The average 5-year return of the S&P 500 is 7.91%, and the average quarterly return of the S&P 500 is 2.23%. And there's always a reason to sell, you guys. Since October of 1989, the S&P 500 has posted a 3,220% total return, including dividends. But differently, the index has grown an average of 10.37% annually over the last 35 years. Bull versus bear market since 1950. So the S&P 500 market statistics, the average bull market since 1950 is 1,941 calendar days or 5.32 years. The longest bull market since 1950 was 4,494 calendar days or 12.3 years, which, by the way, was the 09 all the way up to the 2020 bull market, 2018 bull market. Let's see here. 582.1% gain. Okay. The most recent bear market, 2022, was 282 calendar days long. So 0.77 years, not even a year. And the max drawdown was 25.4%. And that is of the S&P 500, of course. Current bull market as of March 31st, 2025. Yes, we still are in a bull market. 902 calendar days, or 2.47 years, accounting for a 56.9% gain. Okay, here's another fun fact. So the cyclicality of value versus growth, you might hear this on the news where people are talking about, oh, well, I'm going to buy value instead of growth, or growth versus value. Over the last 40 years, value and growth stocks have each outperformed the other for periods of time. However, long-term average annual returns are nearly equal. They're not that much different. And I've got a chart here that shows that, that it's about, let's see here, average for the Russell 1000 total value return, 5-year total returns, 11.42%. And then that's the Russell 1000 value. The Russell 1000 growth is 11.99% on average. So not that much dispersion between the two. Okay, so staying the course, not trying to time the market, time in the market, diversifying, knowing what you own, making sure that you are rebalancing here and there, that you're looking for opportunities here and there, opportunistically, and trying to see where the puck is going, not where the puck has been. And steady hands prevail in this investing landscape. And the data and the facts are there where don't miss the best days, average in on the down days. And sometimes it's better to buy and hold over the long period of time, because you start compounding right away versus delaying the compounding effect that happens over time. It's one of Einstein's observations was one of the mysteries, a miracle, the gift of compounding over time. So stay disciplined, stick to your hard developed strategy, and your financial plan will help you do that, and things will work out.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.